Stocks giving back gains after today's cooler than expected inflation data. Our next guest now cautions there could be more downside if tomorrow's CPI report comes in hot. Let's bring in Ed Yardeni of Yardeni Research. Welcome. It's good to see you again.
Thank you, Scott.
Why do you have that view?
Well, look, I think the big issue for the stock market is the bond market. And the bond market, we argued back in August of last year, I was discounting too many rate cuts by the Fed. We thought that the economy was going to prove to be resilient and strong, and that turned out to be the case. And here we are, up from 3.65% on September 16th of last year to 4.75% thereabouts now. And so that a lot of that had to do with the better than expected growth of the economy, with the Fed probably going on pause. And we also have some stickiness in the inflation numbers. So I think the markets are going to be focusing on the areas of where inflation seems to be stuck above 2%. And a lot of that is in the so-called supercore, which, of course, is services excluding rent inflation. And in addition to that, we've got energy prices going up here. And it was goods deflation over the past several months that helped to bring inflation down. It wasn't services. So now we've got to be concerned that the next couple of months we may have an inflation scare.
I mean, doesn't the PPI, though, tend to be a better read into the PCE?
Yeah.
Which certainly is a more important gauge on inflation, at least according to what the Fed watches.
No, you're absolutely right. It's a very good point. I would say that the month-over-month number was better than expected. But when you look at it year over year, you're still seeing an upward trend in the services area. And the best of the inflation news is behind us for the next few months. But again, that's not the only issue for the bond market or the stock market. I think both of them have had to discount the fact that the Fed may very well be at none and done outlook for the federal funds rate for the rest of the year. And I'm not sure everybody's understood that. Meanwhile, as you said just a few minutes ago, with one of your other guests, we're pretty close to 5%. I think there's something magical about that number. I think you'll see some rebalancing out of stocks and into bonds. I think 5% is an awfully attractive rate.
I mean, are you changing your view on the equity market? You've been positive. You've been bullish. Are you moving that ball in a different direction as a result of the backup in rates?
Yeah, no, good question. I'm still looking for 7,000 on the S&P 500 by year end. I still think that the economy is going to be resilient. I still expect that we're in a productivity growth boom, and I think that S&P 500 earnings are going to be $285 a share this year, which I think is probably one of the highest on the street. So I remain very positive on the earnings situation. Maybe it's wishful thinking, but I'm hoping for a buying opportunity. I'm not recommending that anybody sell into this, but if you've got some cash, I would look for an opportunity to buy. But at the same time, I would also recommend buying some bonds at 5%.
I mean, cash is looking pretty good at 5% too.
Absolutely
so
right.
There's competition again. I mean, I guess that's the point that you're making for certain.
Yeah.
But what happens if the Fed, I don't know, if the Fed doesn't cut any more this year, however outlandish that might be, maybe once, maybe none, is that a problem, or does it not matter as long as the economy remains strong?
I think it would happen because the economy remains strong. You know, for the past 3 years, there's been a lot of talk about a recession. I think that's largely behind us. It may come back, of course. But I think interest rates have normalized. I think 4.5% on the 10-year bond yield, maybe plus minus 25 or even 50 basis points, is kind of the range we're going to see for the next few years. And that's what we had before the great financial crisis. So I think it just reflects the fact that the economy is resilient. It's growing at a decent pace. I think it's going to grow at a faster pace because I'm very bullish on productivity. And you put it all together, and you get an economy that's strong with low moderate inflation, and a stock market that moves higher on earnings, not valuation.
What part of the market do you like the best right now? I mean, if we're talking about earnings, we start to get them tomorrow with the banks, for example. What do you like? What don't you like?
I think you could start with the banks. I think the banks will report solid earnings. Loan demand has been picking up. The financial markets have had more volatility, and their traders are pretty good at making money in that kind of environment. I think M&A is starting to pick up. So the banks, the financials, generally speaking, look quite good. We've got more deregulation coming, and a lot of that's going to benefit the banks. The Fed regulator has left and will be replaced by somebody who's likely to be less stringent about the kind of regulations they want on banks. So financials for sure. I would say stick with technology. I wouldn't be selling technology. I'd be looking for opportunities maybe to buy some more. Industrials still look fine to me. So really all the sectors that we've been pushing have done quite well, and we're going to maybe overstay our welcome here, but we're going to stay with them. And we would overweight the U.S. relative to foreign portfolios. We would overweight the S&P 500 relative to the SMID caps. And we think the S&P 493 outside the Magnificent Seven are all going to be viewed increasingly over the next few years as tech stocks. These days, you either make tech or you use tech to increase your efficiency, your productivity, your relationship with customers. And those companies are going to show good earnings. I'm expecting profit margins to go to a record high this year and next year.